Thank you so much. Hello, everybody. Thank you for joining us. This is Avi Gilbert. I'm going to give you a brief introduction about Elliott wave analysis and how we look at the market a little differently than most. And then I'm going to hand over the mic to Michael Gombeski. Mike's going to take you through the various charts. And if we have time at the end, Mike will try to get to some of the questions. In the meantime, let's get started. Basically, we look at the market, as I said, differently than most. We look at that the market is driven by sentiment rather than news or events per se. And one of the reasons we do, the main reason we do is because the methodology presents it as such. We really don't care about what the news is. The price action tells us everything we need to know. And it's only been over the last 30 to 40 years that a lot of studies have been conducted, which supports our perspective that the news really is, as much as people believe that the news is so important, when you actually look at it from a non-emotional standpoint and you're not involved in watching the news and relating it to the market, their studies have shown that it really doesn't matter. For example, in 1988, a study was conducted by a group, Cutler, Porterba, and Summers, and the study was entitled, "What Moves Stock Prices?" And they were involved in reviewing stock price action after major economic or other type of news like political events, international events. And they were doing this in order to develop a model through which they would be able to predict markets retrospectively. You heard me right on that. They were trying to develop something retrospectively, and then they would try to develop that for a more prospective perspective. So they were not even looking at prospectively yet. They were looking back. And what they found, which shocked them and probably shocks most people, and I'll give you some quotes of what they said. They concluded that, quote, "Macroeconomic news explains only about 1/5 of the movements in stock market prices." And they went on to say they even noted that, quote unquote, "many of the largest market movements in recent years have occurred on days when there were no major news events." They also concluded, quote, "there is surprisingly small effect from big news of political developments and international events." And they also suggested, quote unquote, "the relatively small market responses to such news, along with evidence that large market moves often occur on days without any identifiable major news releases, casts doubt on the view that stock price movements are fully explicable by news." Now, this is not the first, not the only of such studies. This may have been one of the first, but there have been many, many studies all through, even through the 2010s, that have supported this same perspective. And I know it sounds very counterintuitive because everybody loves to relate the news to the market. And they'll do so, again, looking backwards. At the end of the day, oh, the market did this. Well, this is the news that came out. It really doesn't work like that, because how many times you see that the market moves and you don't have a real explanation for it? And this is really, if you're really being honest with yourself, this is really a problem that most people have. And I'm going to read to you one more quote by Robert Prechter. "Observers' job, as they see it, is to simply identify which external events cause whatever price changes occur. When news seems to coincide sensibly with market movement, they presume a causal relationship. When news doesn't fit, they attempt to devise a cause and effect structure to make it fit. When they cannot even devise a plausible way to twist the news into justifying market action, they chalk up the market moves to psychology, which means that despite a plethora of news and numerous inventive ways to interpret it, their imaginations aren't prodigious enough to concoct a credible causal story." Now, I'll tell you this. There are many times you'll see a market move in opposite direction of the underlying substance of the news. And that's because a news event can be a catalyst to a move, but it doesn't necessarily mean it's the cause. What is the cause? Well, it's me and you and all the other investors out there. Back in the 1930s, Mike, and if you can move it to the next slide, Elliott identified that effectively the market is, you can put the whole slide out, Mike. Effectively, the market moves in a very specific form of waves. He viewed the market as being fractal in nature. What does that mean? It means it's self-similar at all different degrees of trend. Now, what does that mean? Effectively, he said that the market moves in 5 waves up, 3 waves back. And what does it mean by being self-similar at all different degrees of trend? Well, as you can see from the chart, waves 1, 3, and 5 move within the primary trend, and waves 2 and 4 move in counter trend. And within the primary trend of waves 1, 3, and 5, each of those are comprised of 5 waves as well. And as you can go deeper and deeper and deeper into lower time frames, and you'll see the exact same thing throughout. That is what it means by markets are variably self-similar at all different degrees of trend. We use this methodology to identify major market turning points. That's why, for those that have followed us over the years, you'll see we have caught almost every single major turn the market has offered, and all the markets that we track, markets have offered during the 11 years we have been open at Elliott Wave Trader. And the reason is because the market gives us this information through this combined sentiment of you, me, and all the other investors that are related in the price charts. So at the end of the day, the only thing I really need to know about how the market's going to move is the price chart. And that's it. I turn off all news when I start my day. And I'll tell you, I have advised thousands. We have almost 9,000 total members across all our platforms. And I have advised them, turn off the news. It'll make you a better trader. And every single one that has taken me up on that has thanked me because their investment returns have improved. Focus on price is how we look at it, and it's all based upon sentiment. Now, with that, I'm going to hand the ball over to Mike, and Mike is going to show you the various charts that show how we track price and sentiment in price and what that tells us about the market going forward. Mike, it's all yours.
Thank you, Avi. Okay, so Avi did a great job of explaining the theory behind Elliott Wave and the methodology that we use to track the markets. So what I would like to do now is get into some real world examples of how we use this in the real world. So we're limited on time, so I'm gonna try to keep things focused mainly on the S&P chart, and we'll get into the ETF that tracks the S&P chart. But before we do that, I do want to take a look back at the larger degree time frame chart so that we can kind of get a basis on where we're at currently in the market and how we use that context to track the markets moving forward on the smaller degree time frames. So as we saw in the previous diagram, Elliott follows a basic 5-3 pattern. In this particular case, I'm showing that 5-3 pattern off of the 2009 low here, which was the last major bottom that we saw after the financial crisis in 2007, 2008. And so we're counting this as a very large degree wave 4. And as we can see from this chart, we're nearing the end of what we're counting as a 5-wave move up off of that 2009 low. And we can count that as our 1, 2, 3, 4 with the COVID low, and then our final push higher in our wave 5 here. And then again, Elliott wave being fractal in nature, we can see within this wave 3, we also have a 5-wave move, 1, 2, 3, 4, and 5. And then corrected move for an A, B, and C for a wave 4. And then our final push higher, 1, 2, 3, and 4. And so our current wave count that we're watching is suggestive that we've bottomed in a wave 4 of this final push higher, looking for another push higher for wave 5 into 2023 to take us up towards the 5,500 to 6,000 region in the SPX before seeing a significant major top in the equity markets. But for now, that does give us an opportunity to trade this to the long side in the various markets. So we're going to zoom in a bit here to the SPX 4-hour chart. And again, if we can remember, we were at this wave 4 low here back that was struck in June. And from here, what we're looking for is, again, being fractal in nature, we're looking for a 5-wave move to the upside to give us a setup to provide us confirmation that we are indeed following this move higher, taking us to the new all-time highs. So in our current structure, what we're looking at is we're looking for a 1, 2, 3, 4. And again, it looks like we're bottoming in a wave 4 currently at current levels. We're looking for one more push higher to give us that wave 5. Once we get that wave 5 higher, we can look for a corrective retrace for A, B, and C for a wave 2. And then once we get that wave 2 correction, we'd be looking for a strong wave 3. This is going to be the heart of the move up, takes us back to new all-time highs, again, up to that 5,500 to 6,000 region for that final push higher in the S&P 500. So when we combine Elliott wave with Fibonacci pinball, which was developed by Avi, we're able to really define our target levels with a very high degree of accuracy. We do need the proper pattern in place, however, before we can use the methodology in our training. And one of that pattern in this particular case is we do need that 5-wave move to the upside. So again, it's 1, 2, 3, 4, and 5. And once we have that 5-wave move, we can then apply our Fibonacci pinball levels to give us those predefined target stops and exit levels. Okay, so this is the S&P 500 chart. This is the XPX, this non-tradable index. So from here, what we're going to do is I'm going to now delve into what opportunities we have in the actual ETF charts. And again, as we're somewhat limited on time, we're going to focus mainly on the SPY chart. So again, from a practical perspective, Elliott wave in conjunction with Fibonacci pinball allows traders and investors to enter high probability trades with predefined entry levels, stops, and target levels. Fibonacci pinball allows for further refinement of the progression of the trade and can give us defined levels in which we know the market is not following an ideal path, which often allows us for an early exit of a position still at a profit. Okay, so this is again a zoomed in chart further zoomed in of the 60-minute chart of the SPY. And again, this is the ETF that tracks the S&P 500. I'm going to use this ETF to illustrate the methodology. However, Elliott wave and Fib pinball can be applied to all the major stock indices. Again, keeping in mind that the predominant pattern in Elliott wave is the 5-3. When we're trading, we look for instances when we can take advantage of the early portion of this 5-wave move. In this particular case, towards the end of June, we had identified a corrective 3-wave pattern, which gave us the indications that we were coming to a bottom. The corrective move was coming to a bottom in early June. So in this region, we had all of the signs that we were coming to a bottom in that larger degree 4th wave as we'd seen on the previous chart. At this point in time, we were looking for indications and early signals that we had struck a bottom. And that early signals and indications were a reversal off of some of our major Fibonacci support levels. We saw that reversal high here in early June, and that was then followed by a corrective retrace, and all this action was corrective in nature. So this reversal off of support, followed by corrective wave action into our key support levels here, was giving us a good indication that we had indeed struck a bottom here and the market was ready to push higher. So at this point in time, when the market was trading in the support range, we were able to identify this as a fairly reliable area to enter trades to the long side. We had our predefined target levels up in this target zone in this box, and more importantly, we had predefined levels which we could know when the trade was going against us and when the trade was wrong. And this is what's so powerful about Elliott wave methodology, is that it gives you the ability to know when you're wrong before you even enter a trade. So you can have a very well-defined trade plan before the trade is even entered, know what your risk to reward ratio is going to be before the trade's entered, and know when you're wrong. So when we were trading down here, the sentiment was horrible. People were scared. People were thinking the market was going to crash. There were very few people who were confident that this market was heading higher. So, and that's a natural human emotion. It's natural to feel that way. But what we need to do as traders is go against our emotion and place trades based on the evidence that we have in front of us. And that evidence is the chart patterns. So we can then place trades unemotionally, place a trade at our support. We can put a stop at our invalidation level, and we can let the trade ride. We can see what happens from there. And again, in this particular case, the trade worked out. We were able to move higher. we did not hit our stop level. We had a 2% risk, and the market moved higher. In 15 days, the market moved up 10%, and then in 29 days, the market was 15% higher, right into the predefined target zone here for the top of our wave 3. Now, we were cautious in this particular instance based on the patterns that we were seeing. So when the market got up to this region, this 402 to 409 level, we were quite cautious in this region, and we were looking for the market to top. The market did extend quite a bit higher, extended another 5% past what we were looking for here, and then we saw this corrected move lower. So now the next thing that we're looking for is we're looking for a larger degree 5-wave move to give us the next setup to trade. So right now, this was our high probability setup, this bottom of this wave 2 into this wave 3 target zone. And now the market's correcting back for what we're considering a 4th wave. But now we need to see that 5th wave higher. So right now, our view is somewhat cautious in the markets. We want to see this 5th wave higher to really give us confidence that the markets are really going to push to new highs, new all-time highs in the longer term. So that's the setup that we had. And this is, again, it's a smaller degree setup. It's a 60-minute time frame chart. It was a 15-day to 30-day setup here. So it was a relatively shorter time frame position. As we move forward, and what we're looking for over the course of the next year or so is we can now, again, because we're fractal in nature on Elliott wave, we can look towards the larger degree setup. So in this particular case, again, we're looking for that 5th wave higher to really give us confidence that we have a full 5 up off of the lows for this wave 1, of what we're counting as a larger degree move. If we can get that push higher, that move back up over the highs that were struck on August 16th, this would give us that 5-wave move, 1, 2, 3, 4, 5. We'd count that as an initiation move of this final 5th wave higher. So we count that as wave 1. We'd then be looking for a corrective retrace for a wave 2, targeting back into the 415 to 400-ish range. Again, depending on how high wave 1 tops, those targets change a little bit. And from there, we'd be looking for that push higher. We'd be looking for a wave 3, somewhere into the 483 to 539-ish zone, and then a wave 4 and a 5. Again, these levels get refined once we see where we actually top in our wave 1 and bottom in our wave 2, but these are the projections at the moment. So assuming that we can do that, get that wave 1 up, that wave 2 down, we'll have something like a 7 to 10% risk for our trade. And the potential upside is somewhere in the 20 to 40% range. Again, just depending on how high the wave 1 goes and how low the wave 2 goes. But that's what we're looking at. And that aligns with our longer term targets on our larger degree SPX charts. Again, where we're looking for an ultimate target in the 5,500 to 6,000 range. That 20 to 40% move off of the next low is what we're looking at as the next major target zone. And again, if we can get that 5th up and that corrective move down, it would provide investors and traders with a very good risk to reward ratio. Again, all by knowing well ahead of time what your predefined entry levels are, stop levels are, and your target levels are. Again, it's a very unique methodology that allows for investors and traders to have a very well-defined trade plan. And it really helps take a lot of the emotion out of the trading that we all feel naturally near tops, especially near tops and bottoms. Okay, so that's a quick overview of what we have on our charts. And we can go ahead and open things up to questions and answers.
We have a couple of questions ready for you. The first one is, what platform do you recommend and why?
All yours, Mike.
There are various trade platforms that we use. And I personally use multiple. I use TradeStation, which is the platform I've used as well. And then kind of the king is MotiveWave, which a lot of our analysts use, and I also actually use. It's really a personal preference. MotiveWave has a lot of good features as far as the labeling. It has standard nomenclature, which isn't available in a lot of our other platforms. From a learning perspective, however, I prefer to actually learn on a more simple platform. I think it really allows you to refine your skills as Elliottian. I kind of equate it to learning how to do math, the hard way, long division versus using a calculator. You never really do long division in the real world, but you still need to know how to do it to get the fundamentals down. So that's kind of how I equate MotiveWave versus a more traditional platform. So,
by the way, I want to add something to what Mike said at the end of it, though, the bigger perspective and where the opportunity resides. Right now, we're waiting for a fifth wave. And if I don't know if how many of you have read a recent article I put out, and it was when we were at the recent highs, 4,300 or so, I said, now is the time to de-risk, because we don't know if we're going to get that fifth wave higher or not. So it was an opportune time when we were at those highs to de-risk. The next opportunity that you're going to get to go into the SPY ETF, if that's the vehicle you choose, is it's going to take a number of months until the market finishes off its wave one, then wave two. So it's going to take several months before you're going to see the opportunity arise. So, when a market breaks out, if we get that fifth wave higher high, the market's going to break out over the 200 DMA. And that's going to cause most of the market to turn exceptionally bullish. 200 DMA is out, time to go. No, because right after that, it is quite likely. Is it definite? No, but it is quite likely that the market is going to pull the rug out from all those latecomers that are now buying the breakout over the 200 DMA. And that's when you're going to get your wave two pullback. The wave two pullback is going to be your initial opportunity. And, there are several opportunities of how to trade the upside a little more conservatively. I discussed that with our members in a little more detail. It's a little more detail than I can go into this short webinar, but there are ways that you can layer into it to reduce your risk for those that are a little more risk averse. So I'm sorry, please continue with the questions.
Thank you so much for your insights, Avi. Our audience really does appreciate them. Next question we have here is, what sectors do you think will push the S&P 500 to the 5,500, 6,000 mark?
I'll take that one. Mike and I don't necessarily track the sectors. Specifically, we have a whole team of analysts that simply do Elliott wave analysis on individual stock charts and the underlying sectors. So it's not really a question that we can really answer very comfortably unless we go back and look at those specific sector charts.
Thank you so much for that. Let's flip the question. Do you think we've seen the lows of this year in the S&P 500, or do you still think that there's more bottom to go?
No, that's going to depend on if we get that fifth wave higher, the corrective wave two. That's what we're waiting for, as Mike just tried to explain. That is what we're waiting for to make that determination. And that's why we said we don't know if we're going to get that, because we said at the top, at the 4,300, great time to now raise cash. We don't know if we're going to get that higher high for a fifth wave yet.
Thank you so much for sharing those insights, Avi. Next question we have here is, why do you think after wave 5, we will not go into a bear market?
Mike, you want to take that one?
Yeah. So again, that is based on where we are in our larger degree pattern. So if we get our wave 5 here, 1, 2, 3, 4, 5, we can see that this wave 5 is not the end of a move. It's actually the initiation of a larger degree fifth wave. So again, this wave 4 here is part of this larger degree fifth wave here. We still need to push higher. We still need another higher high to finish off the pattern. And we can see that again in our monthly chart. We still need to finish off this larger degree pattern. So the pattern's incomplete as we currently sit. So we need a fifth wave higher here to finish off this move from the COVID low, 1, 2, 3, 4, 5. So what we're looking for next is that final 5 wave move, 1, 2, 3, 4, 5. So if we get the fifth wave, that's going to give us our wave 1 of that larger degree fifth wave. That gives us a very high probability that we are indeed pushing higher. If we're unable to get that fifth wave, at that point, this move off of the June lows then becomes a 3-wave corrective move. At that point, things get much more complicated and much more complex. And at that point, it becomes more likely that we are going to see a lower low before pushing higher.
Thank you so much for that. Speaking of that low, where do you think the current support is in the S&P 500?
because of the nature of the manner in which this is taking shape to the upside, it's actually a little too, it's quite large. It's actually 39.50 to 40.95. So it's a large, it's almost 100 point, 100 point, a little more than 100 point support, but that's is what it is right now.
Thank you so much for that, Avi. Next question we have here is talking about gold and silver. What are your thoughts on gold and silver right now?
Let's
Do you see
keep
more
this
upside?
focused on, let's keep this focused on the SPY for now, please, because it's going to get us on too many tangents.
Okay. Circling back to the software. Sorry, this one commenter is saying that they see you're using a green line and a purple line. Is that covering the upside, downside, and the flat?
Better move to another question that's a little more universal.
Okay. Next one we have is there a target for Alt C?
The target for Alt C would really depend on how high the Alt B moves. So it would be our always the initial target zone for the C wave is always going to be where A equals C, so 100% of the A wave. And so we would just need to see where things. Sorry, I've got subtitles going here. Okay. We really would need to see where the B wave tops. So in this particular case, we would be looking for A, B, and C. This B wave could move as high as 46.66. In that particular case, we'd be looking for a move just under the previous low here. If the B wave is more shallow, then that particular C wave could move lower. But always the initial target is right around the 100% of the A wave. So it would be A and then B and C. So again, it just kind of depends on where the B wave would actually top.
Thank you so much for that. And talking about this chart, what's the time frame for these bar charts? Is it 1 hour, 4 hour, or daily?
Again, we're using multiple different time frames. This particular chart that's on the screen now is a 4 hour. We've shown the daily and also the 60-minute and the monthly. So Elliott wave works on all different time frames. Again, because it is fractal nature, and we can zoom into the charts to help give us a better a view of where the markets are at, depending on what level of resolution we need.
Thank you so much for those insights, Michael. Next question we have here is, what impact will a recession have on your projections?
Avi, you want to take that one, or you want to?
I'm sorry, what was the question?
What
The
impact
question
will?
was, what would a recession or another black swan event have on your projections?
You know, economics, you know, this question always troubles me. People try to relate economics and apply the economic models to the stock market models, and it doesn't work. Economics is something, and then the market analysis is something completely different. To explain what I mean, today, you know, the basis behind most of economic theory, especially as they try to apply it to markets, is the efficient market hypothesis. In fact, it is taught in all colleges throughout the country in your economics 101 class. It is the basis behind a lot of this economic theory. The problem is it doesn't work. In fact, if you know the name of the person who actually came up with the efficient market hypothesis, his last name was Fama. I'm sorry, Samuelson. I apologize. Samuelson and Fama came up, but it was they came out in 2010, literally not too long ago. In 2010, they came out and said to us, and let me see if I can find the quote. They came out and literally said, it doesn't work. Hold on. Here we go. And Eugene Fama. Yeah, it was Fama. I apologize. Eugene Fama in 2010 said in the New Yorker, I'd love to know more about what causes business cycles. I used to do macroeconomics, but I gave up long ago. Economics is not very good at explaining swings in economic activity. We don't know what causes recession. We've never known. Now, if the person who came up with the basis behind a lot of the economic theory that people try to use to apply to the stock market has said that, why should we even consider when people call something a recession, or whenever they come up with these economic terms, Is it really worthwhile to try to consider that within the stock market and finance arena? The answer is no. And who was, I think it was Mandelbrot that said the same. Mandelbrot came out and said the exact same thing, that you cannot apply economic theory into the overall market. I just found here, from the availability of multifractal alternative, it follows that today economics and finance must be sharply distinguished. So, to give you an example, back in 2020, in April of 2020, all the economists came out and proclaimed us in recession just as the market was hitting its low in 2200. And the market rallied well over 1,000 points on the S&P 500 before those bright economists came out and said, oh, we're no longer in recession. So, if you guys are trying to relate economics and economic theory to the stock market, you're going to be behind the curve constantly. So I really avoid trying to conflate one of the two, just like exactly what Mandelbrot said, economics and finance must be sharply distinguished. So it doesn't necessarily answer your question per se, but it should answer your question if you're trying to understand the meat of what I'm trying to discuss here.
And just to add to that a little bit, one of the things that we need to understand about the stock market is that the stock market is basically a measure of sentiment. So it's measuring in almost real time the sentiment of the mass public and the mass psychology. So all these other things are lagging indicators, whereas the stock market is really a leading indicator, and it's one of the most efficient and as close to real time as you can get into the mass social mood of the public at large. So everything else lags the stock market, and that's the reason for it.
Thank you so much for sharing that food for thought. I think you've given so much to our investors and traders to chew on. Thank you so much for joining us once again, everyone. This was Avi Gilbert and Michael Golembeski from ElliottWaveTrader.net. Be sure to check out ElliottWaveTrader.net for further resources.